Hello friends. On this episode of the Adams Chetwood video newsletter, we're going to talk about why it is that average investors underperform the market routinely. And I want to set this up by sharing a quote with you from one of my investing heroes, a guy named Nick Murray, who says that wealth is not primarily derived by investment performance, but by investor behavior. And to build that case, he shares the story of a research group out of Massachusetts known as the Dalbar Group, who's been collecting data on investment returns since 1990. And basically they publish the 20-year returns for the most common of indices. So the S&P 500, the 500 largest companies in America, real estate indices, international indices, and so on and so forth. And they compare those to the average performance of the average investor. And I'm going to show you a chart of their findings, showing you a 20-year return. This is from our research partners at Brandeis. And it's going to show you that the 500 largest companies in America returned about 8.2% between 1995 and 2015. I know that's a little dated, but I'm trying to make a point here. 8.2% for the S&P 500, and the average investor averaged 4.7%. So my question to you is, why do investors heavily underperform? Is it because there's a financial conspiracy out to get the little guy? Is it because of, astronomical fees that are a part of investing? And the answer is no, although fees are important and we take those into consideration when we're building portfolios for clients. But again, go back to our quote. Wealth is not primarily derived by investment performance, but by investor behavior. This has everything to do with investor behavior. That even though people know that they're supposed to buy when things are low and sell when things are high, a lot of times you see people do the exact opposite. And I'm going to show you a chart to make that point. So you've seen this chart before. It's from our research partners at JP Morgan. It shows the rates of return of the American stock market going back to 1980. And the bars in this chart represent the rate of return for the full calendar year. So January 1 to December 31. So for example, if you go all the way to the left in 1980, the market was up 26% from January 1 to December 31 in 1980. And if you zoom out, you'll know that there are more positive bars than negative bars, right? Everybody remembers 2008 and how painful it was to be down 38%. Everyone remembers the dot-com bubble bursting in the early 2000s and how painful that was. But generally, there are more positive bars than negative bars. In fact, in 31 of the 41 years measured here, if you just stuck with the plan, you made money. That's a batting average of about 750. That's really good. But even though the probabilities are in your favor, if you just stick with the plan, every year also has these little red dots, these pesky little red dots. And so again, I'll go back to 1980, that even though the market was up 26% for the year, there was a period of time where it fell temporarily 17%. And if you have a $2 million portfolio, that's $340,000 that you just lost. And if we know anything about emotional biases, a gentleman named Richard Thaler won a Nobel Prize for concluding and researching that it feels twice as bad for people to lose money as it feels for them to make money. This is where he came up with a theory of loss aversion, that people really don't like to lose money. And so whenever we experience one of these red dots, people have a tendency to panic. And when they panic, they make poor investment choices. And I'm going to show you this chart from also from Brandeis. They've licensed it from a gentleman named Carl Richards. And even though people know they're supposed to buy when things are low and sell when things are high, it's very common that they do the opposite. And I'll give you an example. You go to a cocktail party and all your friends are talking about how much money they made in company X, Amazon, Shopify, something that's the wave of the future. And after hearing about their success, you think, wow, well, maybe I need to buy some of that company. So by definition, after a big run up in the price of the company, you buy some shares, and then we experience some very routine, normal turbulence in the market. And investors will say commonly, you know what, I just can't take this anymore. I'm going to go to cash. So you have, again, technically bought high and sold low, even though you know you were supposed to do the opposite. This is one of the ways that we help clients with emotional peace of mind, by understanding these emotional biases in behavioral investing and knowing that there's a temptation every time that they see a red dot, and resisting that temptation will not only lead to better investment performance, but it will lead to comprehensive financial peace of mind. I hope that's helpful to you, and have a great day.